All right, let's talk about something that's on every investor's mind. How is it that something happening thousands of miles away can send shockwaves through your investment portfolio right here in India? Well, that's what we're diving into today. The great balancing act between global chaos and your money.
You know, you see these headlines flash across your screen every single day. A conflict flares up here, a new tariff gets announced there, and it's so easy to just scroll past, thinking, well, that's their problem. But should you? Does any of that really matter to Dalal Street?
The short answer? Absolutely. You see, in today's world, the global economy is so tightly woven together that no market is truly an island. What starts as a political headline in one corner of the globe can, and believe me, it often does, create very real financial waves right here at home. So let's really dig into this core tension, this constant battle between scary-looking global news and the strength of our own local market.
And just to show you this isn't some abstract idea, get this. A Moneycontrol poll asked a bunch of market experts what they thought the single biggest risk to Indian markets was, and a whopping 41% pointed to geopolitical issues. Not inflation, not local politics, but global turmoil. That tells you just how seriously the pros are taking these outside threats.
And that really sets the stage for what we're talking about. Picture a giant tug-of-war. On one end of the rope, you've got all these unpredictable global events trying to pull the market down. And on the other end, you have India's incredibly strong economic growth engine pulling with all its might in the other direction. This is the great balancing act every single one of us has to navigate.
So how does this ripple effect actually work? I mean, how does a decision made in Washington or a conflict in West Asia physically move the needle on your stocks? Let's pop the hood and look at the mechanics.
Okay, the first and probably the biggest channel is something called foreign institutional investments, or FIIs for short. The easiest way to think about these is as huge rivers of global money. When they flow into our market, things tend to go up. When they flow out, well, you get the picture. They are a massive driver of momentum.
So what makes these rivers change course? Well, let's look at a couple of classic triggers. Say the US Federal Reserve raises its interest rates. Suddenly, parking money in the US looks safer and more attractive. So what do global funds do? They pull their money out of markets like India. That outflow can directly cause our stock market to dip. Same story with geopolitical tension. When investors get scared, they pull back from what they see as riskier markets, and that makes things a lot more volatile for us. And that rush of money heading for the exits doesn't just hit the stock market. Nope, the chain reaction keeps going. The very next thing to feel the shockwave is the value of our own currency, the rupee.
It's simple supply and demand, really. When all these foreign funds sell their Indian stocks, they're selling rupees to buy US dollars. All that demand for dollars makes the rupee weaker. And a weaker rupee means everything we import, especially crucial stuff like crude oil, gets more expensive. That can light a fire under inflation and just create a negative mood across the entire market.
And that brings us perfectly to the third big way these global shocks reach us, through the prices of essential commodities. See, India is a massive importer of key goods, and their prices are super sensitive to what's happening on the world stage.
Let's take crude oil, the big one. A conflict in the Middle East disrupts supply, and boom, prices can spike overnight. For India, that means you and I are paying more at the pump, and that cost increase ripples through the whole economy, pushing inflation up. On the flip side, when there's major global uncertainty, like a war, what do investors do? They run for safety, and that's when we see gold prices climb. It's a classic signal that the market is scared.
Now, it's really important to remember that this global pressure doesn't hit every part of the market in the same way. Some sectors are right there on the front lines, while others are a bit more insulated. Let's take a look at who's in the direct line of fire.
Just think it through. Our huge IT sector makes most of its money from clients in the US and Europe, right? So a recession over there can seriously hurt their business. Energy companies, they're immediately squeezed when global oil prices shoot up. But hey, it's not always bad news. A global health crisis can create a massive surge in demand for our world-class pharmaceutical sector. And of course, as we all learned the hard way a few years ago, any disruption to global supply chains can bring manufacturing to a grinding halt.
Okay, so the world is a chaotic place, and that chaos creates turbulence in the market. We get it. The real question is, what on earth are you supposed to do about it? Let's walk through a simple survival guide for navigating these choppy waters.
Here's a 4-step playbook. Number 1, diversify. This is investing 101, but it's crucial here. You spread your money across different sectors and even different types of assets so that one shock doesn't sink your entire ship. 2, stay informed.
You don't need to be a foreign policy expert, but you should have a basic idea of what's going on in the world. 3, and this one is huge, think long-term. Geopolitical panic often causes short-term dips. If you keep your eyes on your 5 or 10-year goals, you're less likely to sell at the worst possible time. And finally, number 4, think about hedging. Assets like gold often go up when stocks go down, acting as a kind of insurance for your portfolio. It really all boils down to this simple idea. Smart investing isn't about running for the hills every time you see a storm cloud. It's about knowing where the strong shelters are before the storm hits. It's about preparation, not panic.
And that brings us right back to where we started, that great balancing act. To make this really concrete, let's look at some actual numbers from June 2025 that show this tug-of-war in action.
This risk we've been talking about, it's not a what-if. It's very real. Just recently, a flare-up of tensions in the Middle East sent a brief but very sharp shockwave through the markets, causing Indian stocks to take a hit. That dip was about 0.8%. Now, you might think 0.8%, that's not a crash. And you're right, it's not, but it is a direct, measurable, real-time reaction to a distant event. That's the geopolitical risk pulling on the rope. But remember the other side of that rope? The powerful counterweight pulling back? Despite that temporary dip, the fundamental Indian economy is still forecast to keep chugging along, with GDP growth expected to be 6.5%. And that right there is the anchor. That is the fundamental economic strength that allows our market to absorb these shocks, and more often than not, bounce right back.
So here it is, the whole story in one shot. On one side, you have that constant barrage of global risks, tensions in the Middle East, trade disputes, you name it, all pulling at investor confidence. And on the other, you have India's powerful economic counterweights, that solid GDP growth, strong demand from our own population, and supportive government policies. This is the battle that defines the market. Which leaves us with the ultimate question, doesn't it? The scary headlines aren't going away. The global risks are going to keep coming. The real test, the question for every single investor is this: can India's powerful growth engine continue to overpower that noise and keep winning this great ongoing tug-of-war? Something to think about. Thanks for joining me.